So today, we're going to demystify IFRS 1. Think of it as the official rulebook for switching financial languages. Look, for any company that wants to go global, this standard is pretty much the ultimate translation guide for their financial story. Let's get into it.
Here's a question for you. How do you really compare a company in Brazil to one in Germany? It sounds simple, but the answer can get really complicated. If they're both reporting their finances using totally different local rules, different financial languages, it's like comparing apples and oranges. For investors, for analysts, and even for the companies themselves, it makes a clear, direct comparison, almost impossible.
All right, here's what we're going to cover. First, we'll talk about why we even need a single global language in the first place. Then we'll unpack the specific rulebook for making the switch. That's IFRS 1. We're going to look at how a company creates a brand new starting point, what practical shortcuts it can take, and, this is crucial, how it has to explain all those changes. And finally, we'll tie it all together and see why this whole process really matters. Okay, let's zoom out and look at the big picture here. We live in a globalized economy, right? Capital is flowing across borders constantly, and to make that happen smoothly, you need a common standard to build trust and, frankly, just to make sure everyone understands each other. You see, pretty much every company starts out using its own local rules, what we call previous GAAP. But with so many different local rulebooks, you end up with a financial Tower of Babel. So the goal is to get as many companies as possible on the same page with IFRS, creating this single global standard where financials are comparable, whether the company is in Toronto, Tokyo, or Cape Town. Now, you can't just flip a switch and change your accounting overnight. I mean, moving from one super complex set of rules to another is a massive undertaking. And that's exactly why the standard setters created a specific instruction manual just for this one-time event. And that's where this comes in, IFRS 1. It's a pretty unique standard because a company literally only uses it once for its very first set of IFRS financial statements. Its entire purpose is to manage that transition and make sure that the information is transparent, comparable, and high quality right from day one. The standard itself basically says the goal is to create a suitable starting point. And that's the key phrase right there, suitable starting point. IFRS 1 isn't just about that first report. It's about laying a solid, reliable foundation for all future reporting. It's all about getting that starting line perfectly right. Okay, so how does a company actually do this? How do they create this brand new start? Well, it all begins with one single, incredibly important document, the opening IFRS Statement of Financial Position. The fundamental idea here is something called full retrospective application. And this is a really powerful concept. It means a company has to go back in time and restate its finances as if it had been using IFRS from the very beginning. It's basically rewriting your financial history, but with this new set of global rules. So how does this financial time travel actually work? Well, it really boils down to 4 key moves. First, you have to recognize all the assets and liabilities that IFRS says you must have. Second, you get rid of anything that your old rules allowed, but IFRS says, nope, that's not allowed. Third, you reclassify items so they fit into the right IFRS categories. And finally, you measure everything using the new IFRS measurement rules. Now, rewriting history perfectly is, it's often impossible or just wildly impractical. I mean, can you imagine trying to find a specific invoice from 20 years ago? Good luck. So IFRS 1 builds in some practical relief with 2 special categories of rules. And the difference between these two is absolutely critical. Exceptions are mandatory. These are areas where the rules say you must not look back, usually because it would be a total mess or just wouldn't make sense. Exemptions, on the other hand, are optional. They're practical shortcuts you may choose to use to make the whole process less costly and less of a headache. So here are a few of those mandatory exceptions. A great example is estimates. IFRS 1 says you can't use 20/20 hindsight. Your new estimates under IFRS have to be consistent with what you knew back when you made the original estimate. You can't just go back and change your numbers because you know how it all turned out. That wouldn't be a fair or suitable starting point. And then you have the optional exemptions, the shortcuts. A huge one is deemed cost. Instead of digging through decades of archives to find the original historical cost of a factory, a company can choose to just use its current fair value as its new starting cost. It's a massive time saver for sure, but it's also a big strategic choice because it will affect things like depreciation for years to come.
Okay, so the numbers have been crunched, and maybe some of those practical shortcuts have been taken. But the company is not done yet, not even close. Now comes one of the most important parts of the whole process, explaining exactly what changed and why.
This part is completely non-negotiable. Transparency is everything. A company can't just publish a new set of numbers and expect investors to figure it all out. They have a duty to provide a crystal-clear explanation of how the switch from their old accounting language to the new language of IFRS hit their bottom line.
And the main tool they use for this is called the reconciliation. The best way to think about it is as a bridge. It's a detailed schedule that literally connects the numbers from the old world of previous GAAP to the new world of IFRS, and it shows every single adjustment made along the way.
It's pretty straightforward, really. You start with your equity under the old rules. In this case, let's say it's $1,000. Then you list out each specific IFRS adjustment. So maybe you revalued an asset, which added $200. And maybe you had to recognize a new liability, which subtracted $50. The reconciliation lays out all the math so any investor can see exactly how you got from your old number to your new IFRS number.
All right, let's pull all these threads together. We've walked through the process, the rules, the exceptions. But why does any of this actually matter? What's the real end goal of this whole complex standard?
Well, after all that complexity, the entire standard is really just trying to achieve three things. Just three core objectives that balance everything we've talked about. First, it's all about being transparent and comparable for the people who use financial statements. Second, as we've said, it's about providing that solid, suitable starting point for all future accounting under IFRS. And third, and this is a big one, it has to be pragmatic. It's about making sure the whole exercise can be done at a cost that doesn't outweigh the benefits. It's a balance between perfect quality and real-world practicality.
So, in the end, by carefully following this IFRS 1 rulebook, a company is doing way more than just changing its accounting. It's successfully and transparently translating its entire financial story into the global language of business. And that opens it up to a whole new world of investors, partners, and opportunities.
And that leaves us with a final thought to chew on. If every single company in the world truly spoke the same financial language, breaking down all those barriers to understanding and investment, who ultimately wins? Thanks for joining me.